Welcome to the Daily Brief, where I'll go over the action in the market for Tuesday, January 24th, and then we'll see how things look for Wednesday, January 25th. A pretty sleepy day. A little bit positive in the sense that we really didn't fall apart. We're still above the 200-day moving average. We're still above the trend line. There wasn't a lot of action, which should not necessarily be a surprise because we had some really nice run-ups on Friday and then Monday. To see things slow down on Tuesday with some of our indicators showing that we're, at least in a short-term basis, overbought, that's not really surprising. At the same time, we haven't really done anything to work off that overbought condition. So let's go back and talk about what happened. Right at the open, we did have a lower open. Prices, when you look at the chart, they established a base right at 4,000. Most of the time, a round number like that is just psychologically important. Oh, it's easy to report in the media, and you go, okay, the Dow's down 1,000 points, up 1,000 points. The S&P's at 4,000, it's at 3,000, what have you. Those are just round numbers that make it easy to figure out where we're at with things. As we've been dealing with this price level over the last period of time, few weeks, 4,000 is turning into also a technically important level. That was even established more in Tuesday's session. We set that base at 4,000 and then we started climbing back up and we got above the daily pivot at 4,010. Then we went even above that to go up to the unchanged level, and that acted as the resistance. And we never really got above that. There were a few little attempts during the day, but we never were decidedly above the unchanged level. As the day went on, prices chopped in a narrow range between the unchanged level and the daily pivot, and that's pretty much what happened. We ended up being down 0.07%, not a really big move, but it still goes in the books as a down day. The volume did drop off. It was below average. The technicals were still staying positive. I know it's kind of going in the face of logic right now, but you look at all the charts and we're pointed in the right direction, at least going up. It's getting over this emotion that we should be going down, and probably from a logical standpoint we should be, but we have to follow what the charts are telling us. It's kind of interesting, not today, but yesterday I was reading through, I don't go to bulletin boards where people state their opinion. They think we're going higher or lower. I just kind of look at them sometimes. And if I do ever go to those, it's just to look at what other people post. Kind of like my Twitter account. I never post anything, but I watch a lot of what's going on and just get some information that way. I was reading an article about current market conditions, and then below you can put your comments, and every single one, now it wasn't that many, there were maybe 5 or 6 comments, but every single one was, the market's done, they're just pumping the market up before they get ready to take it lower. There was not a single positive comment that was posted there, and that tells me, and we're surprised the market's going up? Because when everybody adopts one mindset, the opposite mindset seems to come in and take over. Everybody is convinced that the market should be going down right now, and maybe at some point it will be. But when you have folks on a real short-term basis, this doesn't even get picked up by our sentiment indicators, but when everybody is really down on what's happening, it's not a surprise when prices actually start to go up. Inflation and interest rates, that's what's really driving the market right now, and the earnings per share as well as the valuation concerns. Earnings are being released. We're getting into the real heavy part of the earnings season. Fed speak that may or may not come out. And then I've also added an additional one here, the debt ceiling. I thought this would come and go and they would take care of it. Well, it's a political tool. And it's kind of interesting when they say there's going to be shutdowns. It's the things that directly affect people, but it doesn't affect the people that are making the decisions. I find that always interesting. So we just want to keep an eye on that because that could bleed over into the market. Here's the intraday chart. We had a lower open, not a little bit of a gap, but not all that much. And this is the 4,000 level right in here. And yeah, we dropped a little bit below it, but we were, for the most part, just going along this sideways. We came back up above the daily pivot, got to the unchanged line, and just bounced between the unchanged level and the daily pivot, which were not very far apart from each other. Tried to peek our head up a couple of times. That really wasn't working. Came back down to the daily pivot and then closed just under the unchanged level, being down fractionally. What are some comments? There was an exchange-related issue on the NYSE right after the open, something that they're calling a glitch of some kind. but it was resolved quickly, and what will happen is a number of trades will be marked as erroneous, and some of the trades will actually be busted. It's like they never even happened. This happens from time to time. I mean, you've got a lot of technology that's going in to the stock market. For all of it to work flawlessly every day is really kind of amazing, and so every once in a while you'll run into problems. The stock market held up fairly well in the face of a negative environment. Tuesday was kind of a negative day. We were down with price. We had the NYSE snafu. People are really pessimistic about the stock market right now. And we've had a pretty strong run to the upside, and the fact that we haven't turned down is positive in and of itself, at least in a meaningful way. The S&P was able to stay above 4,000, and the Dow was up. If you look at a reading of all the different indexes, all of them were red, even though they weren't down not very much, but the Dow was the only green one. The S&P is still above that trend line, and we keep asking this question, can it stay above that trend line? And then bonds continue to improve. So I have a couple of extra charts that I haven't shown before where we'll talk a bit about bonds. This could be potentially positive for the market. On a short-term basis, we're still extended with our Stochar RSI and our Williams percent R indicators. Intermediate term, the CCI 14 and 20 continue to be extreme positive. Long term, that moving average study, same thing. We didn't go down enough in Tuesday's session to really change anything. The dollar was down and interest rates were also down, and copper is still hanging in there for right now. And that's what we're using as our, hey, maybe things aren't going to be that terrible going forward. Look at what copper's doing. At some point, that may change, but we just have to go with what we see right now. We still have our inverted yield curves, the 10 to the 5, the 10 to the 2, the 10 to the 3 month. Those are still quite inverted. Sentiment is still positive. We're coming in at 63 currently. And we had the IHS Market Manufacturing PMI. It's kind of strange. When I do the weekly video, I have a whole calendar in front of me. This wasn't even listed. It was like there's nothing supposed to be happening for Tuesday, only to find out later that there was. Anyway, this report came out, and not a real big one, not a real market mover. The manufacturing part of this came in at 46.8. The last time it came in at 46.2, so a little bit up. And then the services side, the preliminary reading was 46.6. Last time it was at 44.7. Our trend is still positive. We're getting above that moving average, so we're strengthening as far as our trend, but we're still below 20. So overall, we're in a pretty trendless environment. Our bias, I'm still keeping it as positive, even though there was some negativity within the market. To only be down 0.07% is kind of positive in and of itself, and I'm keeping our momentum at positive. Here is the VIX to SPX correlation, where it really hasn't changed. I didn't have to update this chart at all, but we're working off of this spike, and it's starting to come down, and sometimes where you look at the red lines, that will have some kind of an impact on price movement. We're just not really seeing it yet, and if we are seeing anything, it tends to be more positive currently. The Ulcer Index still below the moving average, kind of lining up more with our sentiment reading now, where we're positive. When this is low, that means that fear is really low. The one-day chart of the equity put-call ratio did advance on a down day. Here's our 5-period simple moving average. It's ticking back up slightly, but we're still working off of this massive spike. And here's a longer-term look at that same chart where we spiked up, we're coming down. We're still below the 0.8 reading. That's the red line right here. And this often gives some support to the S&P. The VIX declined. Even on a down day, we were down slightly. We're underneath 20, so there's a lot of complacency right now. And the bar chart also shows how we've been declining. I didn't include the VIX of the VIX on here because we really didn't move all that much. Here's our trend where we're above the moving average. Green line's on top, even though it declined, but we're still positive overall, and the red line is declining. Here's our daily chart. We're still above this downward sloping trend line. Can we stay above that? Here's R1. That was yesterday's high. Can we get above that? And if we do, that would turn things a lot more positive. Or there's always the danger that we're going to fall down from here. We have the 50-period and 200-day moving averages below where we're at right now. And then we have this other pivot level. So we have a lot of support under if we go down. And there's a significant amount of resistance if we continue to go higher. We may chop sideways for a few days. Stochastics, we're getting short-term overextended to the positive side. That was true after Monday's session. After Tuesday's session, we now have the intermediate term starting to get extreme, but the long term is still going up. Stochc RSI, extreme positive. Williams percent R, extreme positive. BPI, still hanging in there for the most part. CCI 14, overextended, and CCI 20. Chaikin money flow, still hanging in there, and it advanced slightly in Tuesday's session. Short-term fib level, we're right above this 4,006 level in here. That could provide some very short-term support. If we go up, we might hit other resistance quite a bit of ways from where we're at right now at the 41.23 level. Longer term, we do have some resistance above at about the 40.20 level. The Swinland Trading Oscillator based on price and volume are turning back up. That's positive, but they're still below zero, so that's somewhat negative. Moving average tree just showing how we're above the 200-day moving averages. The longer we stay above that, the more these faster moving averages have a chance of turning up and improving the overall picture. Elder Impulse System still positive. Summation Index based on price and volume continue to advance. We're flattening out a little bit based on volume. We'll want to keep an eye on that. And here's the double and triple exponential moving average chart. The one thing that I added over the weekend was this blue line. It's an anchored moving average going back to the all-time high. This could provide overhead resistance, and it's right now at the 40.85 level. New highs, new lows. We actually were able to see a breakout with new highs, even on a day that was an inside day. That's kind of interesting that happened. So this will help our new highs and new lows improve, but still, we're underneath the moving average with the 5. We're flat to slightly declining with the 10. Advanced decline line, not a lot of change here. It's a really quiet day. Still looking okay based on price. We're above the moving average, and we're also above the moving average based on volume. Accumulation distribution. This is still hanging in there. We're above an advancing moving average. Copic curve gave us a buy signal in early January. That is still valid, as well with the Pring bottom fissure, a buy signal. Our longer-term moving average study, we're still extended with the 150, and we turned down slightly with the 200. The Dow, after giving us a recent golden cross, is above the daily pivot, and it actually advanced in Tuesday's session. The diamonds continue to be positive. The Qs continue to be positive, even though it was a rather muted day. The mid-caps are still above this R1 level that it broke through in Monday's session. That's positive, and we're working off of a recent golden cross. Looking more longer term, since not much was happening, I figured I'd bring up a few of the longer term charts. Going back 250 periods, this is the 250 period rate of change where we really bottomed out here and we're going back up. Now this is shorter term. I know it looks like it's really long term, but this is the COVID low and we came down to this level and we have been bouncing up. This chart goes all the way back to 1980, where we could go lower than this, where we broke down below this red line back through the 2008-2009 plunge, but it shows that we're trying to improve after retesting the COVID low. Home builders kind of hanging in there for right now. We're breaking out with a new high with the S&P, showing a little bit of improvement with the home builders. And then when we look at the ratio, the home builders to the S&P, it ticked up slightly in Tuesday's session. The S&P was down, home builders were up, so now they're having a tendency to not go as strongly in the same direction. Semiconductors, we're just getting ready for this golden cross, and there's a lot of buzz right now about semiconductors, and a lot of people are really touting their stocks. They're seeing this golden cross and looking for individual stocks to get into. Emerging markets, this is also showing some strength, and there's some buzz around this. We're just coming off of a recent golden cross here, and we were actually up with emerging markets in Tuesday's session. Bonds are showing some improvement too. Our total bond ETF could be getting ready to give us a golden cross. Here's the world bonds, where we're seeing some improvement here. We're up 0.5% in Tuesday's session. Not quite ready for a golden cross yet, but it could be soon. Then here's a new chart. This is high yield corporate bonds, and this is an ETF showing how we've had a recent golden cross here. And then another chart, investment grade corporate bonds. We focus so much on the treasuries. Those are government bonds. I like to also look at corporate bonds because that can sometimes give us some useful information. With this corporate bond ETF, we're just getting ready for a golden cross. Bonds are improving based on price. That could potentially be lowering interest rates, which is kind of going counterintuitive to what everything else is telling us right now, but we just have to go with what we see. This is also counterintuitive currently. Copper, even though it declined a little bit in Tuesday's session, it spiked up here and it's been hanging out at this level for a number of days now. Looking at a few charts for our possible positive scenarios, the small caps were down 0.39%. We're still above this R1 level that is providing support after coming off of a recent golden cross. Our ratio, even though it declined slightly, we're spiking up with the red line, which could be helping the blue line. The red line is the small cap to S&P 500 ratio. The blue line is the S&P. The staples to S&P 500 ratio, after spiking up, has really been coming down. It came up just a tick or two in Tuesday's session, but this is still looking like a viable spike. So what's our outlook for Wednesday? Not really much has changed. We have advanced GDP coming out on Thursday, personal income and spending coming out on Friday. Not really anything big in Wednesday's session. The technicals remain positive, and we're still above that long-term trend, and I'm still calling it resistance. We haven't been above it long enough, in my opinion, to call it support if we come down. Plus, we're not very far away from it. We came through it a few times in Tuesday's session, so I'm not really looking at it as support yet. We need to break away from this and then leave it in the rearview mirror for a while, and then if we start to come back down, this may act as support. We have the weekly MBA mortgage index coming out, and that's it. And then all the geopolitical events, inflation and interest rates with the debt ceiling down here at the bottom. We'll just have to be watching the news cycles to see, everybody's pointing at each other and everybody has the answer but is accusing the other of doing wrong things. It's politics. Looking at the Stock Traders Almanac statistics for January 25th, fairly good for the Dow, neutral to positive. We're at 57.1% up days. The S&P looking better, 61.9%, and the NASDAQ is also neutral to positive at 52.4%. Then the other things, if you watch these videos, I'll just briefly go through this. For the month, if you go take all the last 23 Januaries to the year 2000, we've been down 56.52% of the time and up 43.48%. For the quarter, we're still in that window of November, December, January that tends to be positive. We're waiting for the January barometer to complete itself at the end of January, so that'll be next week. And then the market does like that we are split between Republican and Democrat. Our scenarios, really hard to go with the downward right now because our technicals are positive and we're not far away from that trend line. Things could turn negative quickly. You get a bad earnings report, you get something geopolitical that happens, somebody comes in and just decides to do a lot of selling because they think we should, that could turn everything much more negative, and the markets like to climb this wall of worry, and believe me, it's worried right now. Hard to go with the up scenario completely, even though we're turning a lot more positive because we're not trending. The ADX is so low right now, but it is getting stronger. It's below 20, and it still continues to be positive, but we're still in a sideways to neutral environment. Our conclusion, the S&P is positive and or but above resistance. Short term, we are positive, but we continue to be overbought. Intermediate term, slightly overbought. Long term, we're positive because we're above the 200-day simple moving average. Thank you. Have a wonderful day, and I will talk to you in the next video.